Great. Oh, yeah. We're still a couple minutes early, so everyone can be at ease. We'll get started in just a minute here. Sorry, Peter. Didn't realize it was. Don't worry, just waiting on you. You still have 30 seconds. All right, good afternoon and welcome back to docket 210515 REO1. We're here today for our 11th technical meeting in this matter. And I want to welcome everyone back. We've got an agenda in front of us today covering 3 separate topics. And per usual, I'm going to turn it over to Pure staff for opening remarks, introductions, and facilitation of our agenda for today. So Mr. Kramer, please.
Thank you, Chairman Gillette. And commissioners, thank you. Nice to see everyone. As the chairman mentioned, my name is Peter Kramer with Authority Staff, and I'll start by laying out our plan for today's technical meeting. So first, our objectives. We're going to continue developing key regulatory reform topics within the revenue adjustment mechanism discussion, and getting into some more of the details on various aspects noted in the agenda today. And secondly, we're also using this format to enable more of a back and forth open dialogue among participants to ensure that we're getting to the substance that we need to advance PBR. Second, I'll address some housekeeping items. So first off, this meeting is being broadcast live on Pura's YouTube channel, and the recording of the live stream can be found there on the YouTube channel after this meeting. We're also joined by a court reporter today. Thank you for being with us. And the transcript of the meeting will be posted when it's available to the docket. To ensure that folks in the room and at home can follow along, please, to our participants, make sure you unmute your microphone to speak. For the folks seated up here, we have our identified representatives from docket participants and stakeholders seated up at the front of the room. And as indicated in the notice of technical meeting, these identified representatives are the main participants in today's discussion. Notably, the authority does intend to make a change to how we've been running these roundtable meetings to allow up to 2 seated roundtable representatives moving forward. So this will be reflected in future tech meeting notices. And this is, of course, subject to available space depending on the number of entities that are looking to participate in any given meeting. Still, despite this change, other representatives in attendance may confer with the identified representatives and may also be recognized to speak as relevant to the discussion and as time allows. So with respect to conferring, if an identified representative would like to confer with a member in the in-person audience, please simply step away from the table and come back to the tables when you're ready to participate again. The conversation will keep going while the conference is happening. And for any other speakers, any other member of the in-person audience who would like to be recognized may approach the podium on the left-hand side of the room facing the front, and you'll be recognized to speak into the microphone as the conversation allows. All right, last housekeeping item, we did not schedule a break today. But we will consider taking a break in the discussion, possibly after the first discussion topic, just depending on how time progresses with the agenda. Next, with our discussion topic format, we have 3 areas to cover today. As you can see in the agenda, the Z factor, operational growth, and a management audit in the context of a multi-year rate plan. For each of these discussion topics, we will provide a brief or staff will provide a brief recap of the straw proposal and subsequent discovery. And we will ask participants for any brief opening comments on these 3 topics before we get into questions from authority staff. During the question time, participants can also certainly ask questions of one another to help clarify positions or help illuminate various topics. Finally, our introductions. So I'd like to ask everyone seated up here at the table to state their name and affiliation for the record. And we'll start, Mr. Horton, with you, and we'll work our way around the horseshoe.
Good afternoon. I'm Doug Horton. I'm the Vice President of Distribution Rates with Eversource.
Good afternoon, Julia Freyer with London Economics here on behalf or at the request of Eversource Energy.
I'm Jacob Hurwitz, Senior Director of Revenue Requirements at Avangrid, here on behalf of UI.
I'm Andrea Van Luling. I'm the Networks Controller at Avangrid, here on behalf of UI.
I'm Wheel from the Office of Consumer Counsel.
And Albert Zablowski for OCC staff.
Great, thank you. So one additional point just before we get into the substance of our meeting today, Ms. Lupoli, if you could advance the slides. We did also just include a snapshot of where we are in the process with technical meeting 11. We have 3 more technical meetings scheduled, and we'll be sending out the notices for those meetings in advance. And then we'll be moving in 2025 into the next sort of phase of the work for the PBR dockets. So just a reminder there on the schedule, which is also posted on the docket system. And Ms. Lupoli, you can go to the next slide. That brings us to our first discussion topic, and I'm going to hand it over to Mr. White to give our staff recap, and then we'll go from there.
Thank you. Yeah, so as you can see here, we just have a brief recap of the Z factor, including a description, a brief summary from the straw proposal, as well as discovery to date. Ms. Lupoli, if you could advance the slide, thank you. And a slightly more detailed description from the straw proposal. The authority recommends that the Z factor be limited to those instances where deferred accounting is appropriate and that such deferred expenses or revenues be eligible for incorporation into base rates through the EDC's next rate case. With that, I'm going to jump into my first question.
Before we get to questions, let's just give folks a moment to say a few words. If you'd like to comment on the straw proposal as it described the Z factor, as Mr. White recapped here. The straw proposal affirms some of the deferred accounting and regulatory asset principles set forth in recent rate case decision, and also proposes to adopt the principles that you see on the slide established in Hawaii in terms of some broad principles under which a event or expenses may trigger use of the Z factor. So for any opening comments, OCC Attorney Wheel, would you like to start? Anything you'd like to say about the proposal or?
Sure. I think the way we understood the straw proposal model of the Z factor, I think we might have put this in our comments back in December. It seemed the straw proposal sort of vision of this seemed really similar to the way that we do deferred accounting now. So regulatory assets specifically, which I don't think we particularly object to. I think like the distinction that we see between something like a Z factor and just a deferred asset or regulatory asset comes down to like when the company gets to start recovering the costs. The practice now, as everyone in this room is probably aware, is a regulatory asset is a deferral until the company's next rate case filing, which in the context of this multi-year rate plan proposal would presumably mean like when going in rates are refiled after the conclusion of the multi-year rate plan. So I think what we put in comments, or at least what we meant to say, is that maybe the distinction for a Z factor comes down to if there is an exogenous event that meets the eligibility criteria, which I'm sure we will also discuss here. That the company there could be a process where the company could come in, seek approval of that cost, and there could be a rate adjustment within the multi-year rate plan. So rather than the process now where there's sort of a preliminary ask with a preliminary authorization subject to review at the next rate case, this might just have a different procedural difference and a potentially more expedited recovery. So that's what sort of jumped out at me about this, at least according to our comments.
Thank you. UI?
I think at various points in this proceeding, UI has expressed or provided comments on three different aspects of what's summarized here for the straw proposal. First, as OCC just commented, with respect to the timing, I think we submitted similar commentary suggesting that it would be more appropriate to reflect a Z factor during the PBR term instead of waiting until the next case. I think at various points have discussed how that minimizes carrying cost implications, potential intergenerational equity concerns. I think that's consistent with how it's done in Hawaii, is my understanding. The second set of comments we've expressed on the Z factor are with respect to the criteria. I think we don't have any show-stopping type issues with the criteria written in the draft decision, but they aren't as clear as they could be in our view. And so in written comments, we provided just some a different way of expressing similar concepts, I think echoing the recommendations of Eversource, hitting, as I'm sure we'll talk about today, costs should be outside the utilities control or exogenous. They should be material. Parties should have an opportunity to review them, things of that nature. And then the third and final element of this that we've previously expressed comments on is carrying costs. We obviously disagree with the findings of the draft decision with respect to the appropriate carrying cost calculation. And I think we've covered that disagreement in a prior technical meeting.
Thank you. Resource.
I don't have anything to add in addition to what's been said.
Thank you.
Thank you. So for Eversource, this is sort of following up on what UI and OCC just said. UI has proposed, UI and OCC are basically proposing an annual PBR adjustment and recovery at that point. Where does, including because later recovery will cause an unnecessary mismatch between costs and revenues, and where does Eversource stand on this?
I agree. And I think that's my understanding of what the Z factor does is it allows for the rate to change by that Z factor. So by including an exogenous factor or a Z factor in the mechanism, you're essentially giving that opportunity to have rates adjust over the course of the PBR term as opposed to today requesting and receiving authorization for a deferral or a regulatory asset to be later recovered. So I would agree that for all the reasons, it would be appropriate to reflect in rates on a more real-time basis.
Okay, thank you. To UI, staying with the concept of annual reviews, does the company have sufficient time to collect the evidential matter?
Yeah, I'm not sure exactly what you mean.
So,
Sorry.
so as an example, if we had this annual review that happens, let's just say there was a storm in December. When are you recovering it if, say, we started an annual cycle on January 1st? Is it waiting a year? Just wondering about the timing of that, how you see something like that playing out.
Sure. So if we had a storm in December, typically we'll be invoiced for that storm. It's typically between 30 to 90 days, but it's dependent on the vendor, right? So we'll do accruals. We will estimate and know how many trucks did I send out? How many people did I borrow? What were my employee expenses, et cetera, that get deferred. Then I know the internal cost very quickly by the end of the close of that period, but anything that I used external folks for, I'm dependent on them invoicing me. So I'll do an accrual where I estimate this is what I think the costs were, and then I wait for the invoices to come in. Typically, my experience is that they come in between 30 to 90 days. Sometimes vendors are delayed in sending bills, so there could be a lag in something. But we would theoretically, within 6 months, have compiled all the costs to be able to submit them for review. If we had an outstanding vendor who hadn't yet billed, we can reach out to them. We can have a conversation with you and say, we've accrued it, we know we used them, they haven't sent the invoice yet. Maybe it's something that we wait till the next Z factor to put in when we know the known costs. But usually the costs are known within like a 3-month period.
Okay.
With support. We know right away, but with the actual support for the invoices.
Okay, thank you. To Eversource?
I think, as I think about an exogenous factor or a Z factor, generally I think of storms as being separate, although it can be considered in the sense that a Z factor to me is for something that is like a change in, and maybe this is not how Pure is contemplating it, but what we had recommended in our response was actually similar to what exists in Massachusetts. Not to say that has to be how it's done, but there would be a triggering event, a change in tax law or regulation or policy, something that imposes a cost or reduces a cost. Generally, it's an imposition of a new cost, whether it's increasing inspection activity or a change in tax law that increases or decreases taxes and then has a corresponding impact on the cost of service that is of a material nature and not otherwise contemplated in the rate plan. So these are discrete events where you can point to an event and say, this happened and now the cost impact is X. And I would say, so it's not something that I would expect to be an annually recurring event. In fact, in my career, we've had exogenous factors and there's been very few examples. In Massachusetts, I can only think of one where it was a change in property tax valuation that triggered a significant change in our cost of service and therefore warranted exogenous treatment. So you could include storms in that. I think either way you do it, whether it's as a Z factor or some other factor, I think storm cost recovery obviously is a priority issue in a large dollar amount. But I think for the reasons that we said, that Ms. Van Loonling said, there's going to be timing considerations that might not lend itself to an annual review as a Z factor, but could lend itself to an annual review in some other reconciling mechanism. I'll just say that. I think it helps to get on a regular cadence for storm invoice review because of what we're experiencing now. We've got a large balance that's out there. There's going to be a rate impact when that goes into rates. And it's a slog to get through both the preparation and review of the invoices that we go through for a storm cost prudency review. So I think there's a lot of reasons to get on a more regular cycle, but I didn't contemplate it being as part of an exogenous event necessarily for those reasons, because a storm hitting in December may not just naturally work itself out. I know we at Eversource have large gaps from when the invoice comes in, and then a lot of time spent evaluating. I mean, invoices for storms, I never realized this until I had reviewed them myself, can be hundreds of pages. And you're going through and validating all of the line items there. So it's a very involved process that, it's just might warrant a different treatment than a Z factor.
Okay, so in your mind, the Z factor is really fairly unusual items, whereas a storm, you don't know when, but they will happen.
Correct.
Okay, thank you. And in Massachusetts, do they, just curious, like you said, we could do it however we want if we do something like this, but does Massachusetts include storms in their Z factor?
So that's a great question. I think, I do think in Massachusetts, I think that for an individual event that exceeds a certain threshold, that will get reflected in the PBR mechanism as a change in rates. I don't know if it's as a Z factor. I would need to confirm, and I could do that on a break,
Okay,
and report back.
thank you.
And if I could just add a little bit more
Please, sure.
context to respond to your first question about the timing. Our UI's affiliate, Central Maine Power, is not subject to a performance-based rate plan, but they do reflect their storm costs it's called the annual compliance filing in Maine. It's comparable to the RAM here in Connecticut. And there, just to give you a sense of the timing, there's an initial filing that happens in March that reflects primarily the amounts accrued by the utility. We've gotten a significant chunk of our invoices in time to make that filing, but there is a heavy accrual basis. And then there's a subsequent update either in May or June, once the company has received a higher percentage of its invoices. If necessary, there will be an adjustment in the subsequent years ACF if there's any accrual at all left in that May or June update. But for the last 3 years and in Maine, there have been some extremely significant storm events right before the end of the year. December 17th, there was a very significant storm event in 2022, followed by Winter Storm Elliott, December 23rd in 2022. And just to give you a sense of, like, there was a storm right at the cutoff, and we had that March filing, May, June update, and then as appropriate, a true up in the following year. And then I'll also add that I think all of I hadn't really contemplated storms as in or out of the Z factor as a question, but it strikes me that I think all of the justifications for including Z factor adjustments in the annual PBR formula would apply to storm costs as well. If you're sitting on a balance for a period of time, or I think all of those justifications would apply to storm as well.
Okay, thank you.
A follow-up question to make sure that we've got a clear understanding on the annual review process that's contemplated or proposed among participants here that is somewhat different from what's in the straw proposal right now. And the question is really just on an annual or interim review cycle, some period that's happening within a multi-year rate plan period, what then, or when does the prudency review of those interim reviews take place? Because I think what's proposed in the straw proposal is, I think, very clear that it happens in the next rate case, and that's also the time of cost recovery. But we weren't totally clear on what the prudency review schedule would look like in an alternative proposal. Please.
So I'll answer in two parts. First is just to provide context for how that prudence review in Maine has happened historically, and then offer some thoughts into how that might work for non-storm Z factor items here in Connecticut. In Maine, that prudence review happens as part of the annual compliance filing. The company makes that March filing, is issued discovery, their technical hearings. In 2023, there was some dispute about the prudence of the company's 2022 storm costs. So that proceeding continued while the public advocate submitted testimony, and then the company responded. And there was a back and forth process that was where that particular prudence review happened. With respect to other non-storm Z factor costs, I could see a couple of opportunities for that review. First is, it strikes me that the company will probably have to make some sort of filing to receive eligibility for Z-factor treatment, depending on whether the costs have been incurred at that point or would yet to be incurred at that point. I think the prudence review could either occur when the company makes the filing seeking approval for Z-factor treatment, or if necessary, in a subsequent RAM proceeding or whatever mechanism it is that brings these PBR adjustments to reality. If the costs have not yet been incurred at the time we make the filing, of course, they would need to be reviewed for prudence. And I think whatever mechanism we use to calculate the PBR adjustments on an annual basis, if that's the RAM, I think would be a venue for that as well.
And I would agree, and I did confirm, so sometimes it's better to be lucky than good. I was mostly right, I think, in Massachusetts. So in Massachusetts, and we had proposed for storms that are individually greater than 25 million, that those be recovered as a exogenous factor. The department did allow for that review, but the recovery is not through the Z factor or as an exogenous event. It essentially says that if we have a storm individually in excess of 25 million, we can get recovery as an exogenous event, but the actual rate change occurs in a separate mechanism called the Storm Cost Adjustment Rate, or the SCRAF, in Massachusetts. So it's a separate set of letters that lets us recover those costs. And in terms of the prudency review, again, so if it's contemplated that the Z factor is for a discrete event that doesn't happen very often, but it's not a storm, but it's a discrete activity, my experience is that you would be doing like Mr. Hurwitz said, because there are a few different ways that can come into being. It could be that there's an exogenous event that is a one-time, if you will, cost. And the example that I often think of is if there is a legislative mandate that requires a one-time inspection of meters or something that you wouldn't otherwise do, that's going to happen and then be done. That's a discrete set of costs, not expected to recur. I think in that type of an example, we would seek exogenous treatment. I'm sure there would be some communication with PURA and authorization that we think this qualifies or will qualify, so that we can have applied deferred accounting to it. Once all those costs are then known, we would present them for review and recovery as an exogenous factor. Another type of an exogenous event could be a change in cost, like a tax change. So a tax increase or decrease that will happen and then recur. So that will result in an overall change in our cost of service and then remain in place until rates are reset. And in that case, I think the same type of process would happen. Once we are aware of it coming, we would notify PURA and try to get assurance that it will be treated as exogenous, and then present our evidence as to what the impact is on rates. And we would want that, rate change to happen along with the prudency review, so that we're having rates that reflect prudently incurred costs up or down based on the exogenous event, and that we're not carrying some, uncertainty along the way as to whether or not we'll ultimately be authorized to recover those costs. So we would expect the prudency to happen concurrent with the authorization to put the costs in rates or the credit in rates if it's a reduction.
Thank you. To OCC, staying with the concept of annual reviews, does OCC feel that it would have adequate time to conduct a prudency review, for example, within an annual reconciliation?
A good question. We did think about this. I'll start by saying we didn't see storm costs as being outside the Z factor, although I do understand some of the company's concerns for the reasons I'm about to say in response to your question, which is a practicality concern, because we're trying to think through the mechanics of how the Z factor should work, and we were kind of like coming up with a hypothetical, like, okay, you have a 3-year multi-year rate plan. Let's say on year 2 a storm happens. Okay, the company can come in and potentially get a rate adjustment before the end of the multi-year rate plan. But then practically, what does that mean? There needs to be time for there to be this prudency review at some point within or perhaps after rate year 2, and then you're already in rate year 3. So now you've already adjusted rates. So at that point, you may as well practically just do it in the next rate case anyway. I think we recognize that is a issue, but it does seem like kind of a case by case. I mean, I think I see the Z factor as a case by case mechanism by its nature. So in my mind, I would think of the term annual review as like there can be a review on an annual basis, but there are presumably going to be some years where there are no exogenous costs at all. And sometimes there will be years where there's more than one and they kind of happen at different points in the year. So I think there does need to be a practical solution for how to manage the work of figuring that stuff out. But it's, you know, I'm again giving you a terrible and an unhelpful answer here because sometimes I can imagine there being costs that require a ton of work and time to sort out. And maybe those happen, as Mr. Hurwitz was saying, at times that don't necessarily align with the procedural framework. Like if something happens the month prior to a normal filing time, and sometimes that's not going to be an issue. So I guess the best I can offer is I think there needs to be some sort of flexibility on generally among everyone to figure out, you know, I think the framework just needs to contemplate that sometimes that's going to be an issue that needs to be kind of hammered out.
Thank you.
If I could just add one more comment, kind of piggybacking off of Attorney Wheel. I think I definitely hear the, like, well, if a storm happens in rate year 1, then you make the filing in rate year 2, it takes till rate year 3, and then you're like already at the next rate case anyway. I think you could back that up a year and like, well, what if a storm happens while we're litigating a rate case? So then do you have to wait 4 years until the next one? And I think the like ramifications of waiting until the next opportunity will be less if these costs are addressed on an annual basis. You know, if you wait until rate cases and you miss the window, that's potentially 4 years that, you know, that balance is sitting there. If you do it annually and you miss the window, it's just 12 months. So I think that I just wanted to offer that for the group's consideration.
I'll jump in and say I agree. I didn't mean to suggest like maybe we should just scrap this whole idea. I just meant sometimes it's not going to align necessarily, and we're going to have to come up with ways to, you know, maybe it is going to have to be in the next rate case for that particular storm just because that storm happened and the next rate case is within 12 months of the storm. I didn't mean like let's.
I'll just echo my agreement for everything else you said, the case by case and importance of flexibility. I agree.
It
And-
seems, oh, Mr. Horn, go ahead.
I'm sorry, I just was gonna echo the echoes. I think as it relates, and I think that's why I think in my view, storm cost recovery does warrant potentially a separate process altogether or a separate discussion because we know there are going to be storms. We know there are going to be storms that would qualify for special treatment. And today we don't have a mechanism for that at Eversource. The numbers are staggering. There's $1 billion of storm costs that have been incurred and not recovered. We filed for 630 million of that. We have 400 million that we're still compiling, you know, ourselves review. So there is a lot of work that happens to support a storm proceeding. Our schedule for the 600+ million that we filed takes us through October of next year. So I think if that's the framework, it does not qualify for a Z factor because it's not going to, they're just practically not going to have the storm, accumulate the invoices, review the invoices, file the invoices, go through the prudency review and have them set in rates it's not going to happen in a concise time frame. But if I think the value in having a Z factor, or I should say a rate adjustment for storms are many. It mitigates the bill impacts, it mitigates the carrying charges, it mitigates the intergenerational equity issues, and certainly from a company perspective, it helps with cash flow considerations. I think there's a lot of reason to do that, but it's still an involved process that might not lend itself to what I'm viewing as a Z factor, which is either a one-time thing that is not expected to recur. It's like a guardrail or a safety net, or it's a change in cost structure that wasn't contemplated when you set out on this multi-year PBR term that warrants separate adjustment in rates on a more timely basis. And I think there's a lot of ways you can deal with storms, but I think I can see us getting complicated and tripped up, or the conversation getting complicated if we use storms as the example for a Z factor, because it's a multi-year process. If we wanted it to be a Z factor, I think really the reality and the simple thing would be you'd have to get comfortable having a rate change take effect subject to reconciliation, which is something that can happen with storms. We have that in place in Massachusetts. The process has become more routine in terms of the review, the documentation, the form of our filings. Rates can go into effect if there are adjustments, generally minor, and they can happen after the fact. But I don't see that as being an appropriate framework for other things that I would consider that would be more of a Z factor exogenous event, where we would want to know, and I think Pura would too, what's the cost change prior to putting it into rates? Is it appropriate as an exogenous event? Can we document it with supporting documentation that justifies the need to change rates? Is it material? I think all those things is a compact assessment that could be done in a time frame to make a Z factor adjustment that storms, I just think, becomes an entirely different conversation.
I guess I'm struggling a little bit then to see, okay, then if it's not through the Z factor, it would be a separate storm mechanism. And what would that mechanism be? You described what takes place in Massachusetts, but another piece of what you just highlighted, Mr. Horton, was that with the Z factor, we'd want to know what the costs are before they go into rates. And why would that not be the case for storms too? That we would want to know what those costs are before allowing them to go into rates subject to a prudency review, but have the same sort of approach.
I think you would, and that's what I think for storms, it's a whole separate conversation, because if we take for CLMP right now, we have $3 million in rates for storm costs in base rates. There was a level of $3 million established to go towards catastrophic storms in our prior rate case. And what that is intended to represent, and maybe it wasn't this way at the time, but in Massachusetts, I'll say that the comparable amount is, I think, $32 million. And the way that we arrived at that number in Massachusetts was to look at the frequency and magnitude of storms that qualified for catastrophic storm treatment over a period of history. And we said, okay, if we take out the outliers, we're trying to get to a place where we're not recovering or evaluating in advance the prudency of those costs, but just essentially how much is storms annually, these storms, these major events that qualify for special rate making treatment, and how can we get a funding mechanism to fund those, so that the idea, at least in theory, is that we're collecting through base rates adequate dollars to go and fund these recurring events, but that are not set in rates at a representative level, if you're tracking what I'm saying. The idea was to say, we don't know what the amount of these storms are going to be. Some are, and they happen infrequently, although much more frequently nowadays, and at various levels of cost. So we're not trying to get a representative level in rates, but we're trying to acknowledge that they exist and we need to fund them on an ongoing basis. So it's an involved conversation to say, first of all, what is the amount of recovery that should be in base rates to go to fund the storm fund, which I think we would argue is going to be much more than $3 million or whatever the dollar amount is. Then as those events happen, if that storm funding mechanism is broken, if 32 million is not the right number, it's less or it's more, then there's a rate mechanism, a companion rate mechanism that accompanies it. So if everything works perfectly, if that 32 million was designed appropriately, you wouldn't need an exogenous rate change or any other rate change, because as storms are happening, we're funding them with the storm fund. It would only be in the event where a single event or numerous events happen that requires a change in rates to get things back on track. And that's where I simply say, then it becomes a question for PURA. How does PURA want to do that in balancing the interests for customers so that there isn't a large rate spike coming in the future? If we're doing like is the parameter now, where we're just holding on to the costs, reviewing them, and then reflecting them in rates in the future, you can imagine the rate impact of $1 billion regulatory asset being recovered in rates, versus if there was a way to have that rate start to flow earlier, it would help eliminate that rate shock and improve the cash flow metrics for the company and everything else that I said. But I think that's my point, is we know these storms are going to happen. It's not like something else that when we design at the outset of a PBR term, we don't know is going to happen, which is what I view the exogenous factor to be trying to cover for. The storm cost recovery mechanism, there's a lot of different ways that you can approach that. But that's all I'm trying to say, is we know they're going to happen. We just don't know the level. I don't think PURA would want to put rates in effect prior to determining prudency review, but for all the reasons I said prior, it doesn't really lend itself, in my mind, to a Z factor cadence, which would be something that is, like I said, more confined, a one-time event potentially that we are going to maybe never see. And it's just the guardrail for up or down.
Okay, thank you. That helps to clarify my understanding of where you're coming from with that. Did anyone else want to respond to those comments?
Just last, I'm not responding to myself. I also just wanted to mention, so that what I described is what's in place in Massachusetts, and that's
Right.
what we're proposing in New Hampshire as well, where we're proposing PBR. We're proposing performance-based rate making with an exogenous factor and a change to the storm cost recovery mechanism that would allow for more frequent updates, because just like I talked about here, although to a smaller degree, there's a large balance of storm costs, and the parties up there are asking, like, why is this so big? Why can't we have recovery have happened in smaller increments over time? So we're trying to address that, but not through the Z factor.
Understood.
I do have, if we're still doing responses. I think, right now we have a storm reserve, which I think is the $3 million or so that Mr. Horton was referencing. And then for costs that exceed that storm reserve, we have the treatment we have now and the infrequency of that treatment, which results in the $1 billion level of outstanding costs that are, built up over several years. And that's obviously the problem that OCC is interested in resolving. But I wonder, so we kind of already have two pieces here. We have like a storm reserve, and the notion of that is that there's some amount built into base rates that's supposed to generally allow the company to recover the operational costs it expects to generally incur in like a normal year. Then we have something outside of that. But I think what I hear from the companies is that for like large storms, as we were discussing before, there's this concern about like the efficiencies of actually being able to tackle that in something like the Z factor we're talking about now. So maybe a model where there's something like a storm reserve, which is sort of a floor, and then there's also a ceiling, and the space in between there works like a Z factor, and the amount that exceeds that ceiling rate kind of gets a sort of set aside to be a scram or a scrag or whatever. Okay. I guess I'm just thinking out loud that in my mind, maybe that would resolve the couple of issues here, being that like, I'll go back to the reserve because it kind of goes back to some of the comments we made with respect to the Z factor generally. Is there's also the problem, which I envision is going to be worked out in the prudency reviews, of making sure we're not double recovering, because some amount of, in anything a company does, some amount of what they're doing is already in base rates, and some, when we're working on an exogenous cost, some amount of that is incremental. And I think the storm reserve now kind of works as a kind of, at least should work theoretically as a handy tool to kind of separate, like start being able to draw that distinction, because you can kind of like measure the costs that are in excess of that reserve. So I think theoretically, I think, setting a kind of floor level could be similarly handy. And maybe, I don't know. I guess that's all I'll say, except that maybe the idea is that there's kind of three mechanisms, just to make things, easier for everyone instead of just one.
I think I follow, and I think so. In Massachusetts, the idea was that we have a set level in base rates for these not exogenous events, but the major storms, and it's not prudency. It's just a cash mechanism or a rate mechanism. So it's money set aside, and it was designed to say, based on history, if history repeats, 32 million a year. And then there was a floor and a ceiling to say, if history doesn't repeat, and we could only be so lucky that no storms happen. Well, we've collected 32 million from customers. That isn't going to fund anything. So if we get to a point where we don't need it, we'll give it back. We'll automatically credit it back. Similarly, if that doesn't turn out to be the case and the 32 million is insufficient, we can have a way to adjust rates in the interim. And I think that's all I'm saying. I mean, I don't want to give the impression that I'm opposed to having it be a part of the Z factor. I think it makes all the sense in the world to have a rate changing over the period of the PBR term for storms. I am just for the reasons I've said, I think having it be part of the Z factor will just become awkward for all the practical considerations we're talking about. Where again, I just view the Z factor as a safety net, up or down, not intended to be used. Storms is something we know we can't solve in base rates. We're not gonna get it right. It's gotta have a separate process and mechanism for it. We're not trying to get to a normal level for storms. It just can't happen. So something else has to come into its place. It could be the Z factor. I think we're just gonna have to work through these logistical challenges that could make the rate never change, because by the time we get the invoices, file them, go through the prudency review and implement the rate, we're already into our next PBR plan or rate case or whatever.
So for Eversource, you may have said this, but I just want to ask the question. How would the guardrails differ if, say, storm was not part of a Z factor? How would the guardrails differ between storm and non-storm exogenous events?
I think the only thing I don't see on the slide that's being shown is that initial trigger for what caused it. See, like the cost must be outside of base rates. I agree with that. Cost must have been prudently incurred. I agree with that. Must not be addressed by existing rates. Also agree with that. It must be material. So I think all those things I agree with, but that could be anything. That could be, we could come up with it and say, hey, this is a new thing I thought we have to do. So sure, what do you think? I think it's got to be, the idea of it is it's an event that's happened, an exogenous event. Exogenous meaning outside of our control. So what is that? That's a change in tax law or regulation or legislation, a new requirement on the utility, something that PURA has imposed on us that we do, that we couldn't have anticipated, and then all these things come into play. It's a special circumstance, and it's something that couldn't have been anticipated, because again, with PBR, at least my understanding all along has been it's going to come with an rate case for a period of time. So we don't have the typical recourse to be able to address for those things. When unanticipated circumstances happen and we need to either file a rate case or have a regulatory asset treatment, that's the intent of an exogenous event, is to say when something like that happens, that's not part of the plan and wasn't contemplated and isn't otherwise in rates, you have to have a mechanism to adjust them. And again, for storms, I don't see that first trigger being appropriate. We know storms are going to happen. We just don't have enough information to put a representative level into base rates for these catastrophic events. So it definitely warrants discussion on how do we deal with it during the PBR term. But again, I just think exogenous, it's missing that one piece, and we put it into one of our responses. It's that change. It's a specific, discrete triggering event that we can all look at and agree, yes, this was a change in legislation that impacts the utilities or something that caused us to have a cost. And then the rest of the things come into play.
Thank you.
I'll just add that, I don't know that I have a strong issue with carving out storms as slightly separate from the Z factor, if we call it like Z factor for exogenous costs or Z factor for storm costs. We want to invent some new acronyms here for our utilities. But I think I'm kind of in my head separating the question of what is the right storm cost mechanism for, like, what is the right cadence to reflect that storm cost mechanism in rates. Like, I know Attorney Wheel was suggesting some, tiers or floors and ceilings. I almost see that as a separate question from how often do you reconcile the company storm costs. I think I understand UI storm costs. I'm unfamiliar with CLMPs, unfortunately, but UI storm cost recovery mechanism, we collect $2 million a year in base rates through major storms. And then to the extent we have major storm costs, that would be added to the reserve and gets funded in part by the $2 million, and it's reconciled in a rate case. I see the question of how that interacts with PBR as is the right cadence for chewing that up annually or once every 4 years. And then separate and apart from that, we could explore whether that's the right mechanism for storm costs. But I see those as slightly separate questions.
Thank you. So a question for Eversource. I think this is just to clarify. I think I've heard it in the discussion, but to just be clear on it. Massachusetts was mentioned in relation to property taxes being as an exogenous event. I don't know how the Massachusetts property taxes work. I know how Connecticut works. I think I heard Mr. Horton mentioned valuations, so different from rates. Was that a one-time? I know here in Connecticut, our property taxes basically go up every year. You're saying this is something that's different than that, a property tax rate change you're talking about, just to be clear on that?
Yes, yes. So in Massachusetts, what was it? Reproduction costs, new less depreciation. There was a change in the method
Okay.
that property taxes were calculated. It wasn't just that the mill rate's gone up
Okay,
or the assessed value's gone up. It was the change that historically property taxes were based on our form of list, which is our net book value in each municipality.
Mhm.
And in Massachusetts, the tax code or what have you was changed so that it was this new method, which significantly increased the property tax base, causing an exogenous event.
okay. Thank you.
And that's what I mean. There was a trigger, like we had to go in and say, hey, this isn't just property tax mill rates have gone up. There's a specific thing that's happened. It was the topic in the proceeding. We had to justify and move our way through.
Thank you. Thank you.
Just as another example from a law change, so in New York, one of the exogenous events we had, it was on January 1st of this year of 2024. The law changed to a prevailing wage rate, meaning that you had to offer, not us, but all of our contractors had to offer a minimum amount of wages to all of their employees. So all of their costs, particularly for the gas business, increased 40 to 60% because they now had to pay 40 to 60% more due to this law change. So that's like an example of an exogenous event that's outside of our control that came from a law.
Sure. Thank you. Question for OCC. How do you adequately define or limit costs that are eligible for inclusion within a Z factor to ensure the strength of the cost containment within the revenue cap formula?
Yeah, I think it's like I think the only way to do that is on a case by case basis as part of the prudency review. I think that like I don't think we had thought about the kind of nuts and bolts procedure of like how the authorization timeline would work as much as some has been discussed here. And it does make sense to me. I think what I'm hearing from the companies, I forget which one, is the idea that there'd be an initial sort of request that would be maybe more administrative, that would sort of say, hey, this thing happened. Can we set aside, can we book these costs separately and then come back later with our receipts and seek review? And that makes sense. And I think that kind of administrative, the check on that initially could just be at a surface level of like, is this the kind of thing generally that meets the eligibility criteria, meaning those factors on the bullets on the screen, and maybe a materiality threshold, but particularly because at that moment there is no rate impact, right? Like all that the authorities saying is, sure, we agree, you can go ahead and classify those costs using your own internal processes as a separate cost to be recovered later. And I think in the prudency review, there's got to be a lot of conversations about the separation between those costs that should be part of the ARM and are subject to cost containment mechanisms, and those things that where there were kind of no amount of cost containment incentive could have prevented the costs. I mean, I think that gets to them being outside the utilities control. But I think there is a lot of work to be done there, and how you do that work is complex. Like I think that can be really difficult. As I think everyone in this room has tried to do a little bit of that in rate cases, and it's not easy. But I think that's what makes sense to me, is that's the kind of the place to do it, is rather than having a preliminary kind of list that applies to that initial application, that it's more about what qualifies for cost recovery than what qualifies for being set aside on the front end.
Thank you.
I was just going to add, and we put this in response to UPA 57, And that's the first criteria that we recommend, is that the cost is a cost change beyond the company's control. But I think more important is that the cost change, and this is what we put in, the cost change arises from a change in tax laws or accounting change or regulatory, judicial, or legislative changes. Because again, those are things that are objectively outside of our control. So to qualify as an initial step for exogenous, it would meet that criteria. It's not something we could have efficiencyed away. It's been imposed. We can't do anything about it, but to abide and follow the law. So that's why I think that criteria, which is missing, is important.
And is it fair though to say, Mr. Horton, that that criteria is only essential if we're going to treat storms separately, right? Because that criteria would not apply if we're including storms in the Z factor or some other sort of exogenous or disaster sort of event that maybe is not a storm or something that just triggers some unusual cost. Because I guess a concern that I could see happening is if it's limited to that definition that you're describing and there's some other cost that's not, we're not contemplating here in this room today, but it meets the criteria. Otherwise, it would not really be helpful to anyone if it then doesn't fit the criteria and then we don't know what to do with that cost.
And I think this is why it's important to have guardrails in place, up or down. And that's that's a comprehensive PBR solution. And we keep talking about that, would have those guardrails. So on the one hand, the goal of exogenous in my mind is that you're catching for those one-off things that aren't going to happen often. And again, I do think there needs to be a solution for storm costs. I'm not opposed to it being in the Z factor. I just think it complicates. I think our position is that if you're going to include a Z factor that is broad, I think you're creating these potential points of disagreement along the way. Well, was this controllable? Why didn't you? I just think it's going to lend itself to a lot of litigated outcomes, as opposed to if it's a discrete event like I'm talking about, then we're arguing over, well, did this change in tax law happen? And that's going to be difficult to argue on any side. And did it result in the cost change that the company is saying it did? I think that's all you're focusing on. Once it hits those things in its material, well, the exogenous mechanism allows for recovery of it. I think the more subjective you make it, the harder it is to actually implement it. We're just going to fight. I do think storms needs a solution, though.
If I can add, just based on my experience in other jurisdictions, when we've discussed this issue, specifically to your question about cost containment, one of the reasons that I think everybody in this room, and including also the straw proposal, has suggested a materiality threshold is actually a cost containment mechanism. It ensures that not every exogenous event, every little small event qualifies for treatment. So it is in some ways putting pressure on management, even when they have smaller exogenous events, to manage those costs through efficiency initiatives and other fun channels, because they don't rise to the materiality threshold where they can apply for a Z factor. So we've discussed this elsewhere in other jurisdictions too, and I think it's well recognized that that's a cost containment feature.
Sorry, just the last thing I would say, and I think, Mr. Kramer, you were contemplating of putting storms aside, although storms isn't aside, except only in my mind, I realize that. But if storms is put aside, then how can we account for things that are cost changes that arise that meet those criteria and aren't how I've defined it or tried to, by saying it's out of our control and it's a specific triggering event. And I think that's why we also come back and continue to caution throughout this REO1 proceeding, is that rates have to be set initially and at the outset to reflect our cost of service, and along the way to ensure that we have a reasonable opportunity, but not a guarantee, to earn our authorized ROE. Because if they're not, or if a cost change has come up that isn't contemplated in the plan that we can't efficiency away, we're not going to be able to stay out of a rate case. Our only recourse will be to file and to update rates to reflect those costs. And that's not our goal or intention. That's why you will sometimes see guardrails or safeguards on the lower end too. So earning sharing would be symmetrical, that you don't just share if you over earn, but you have some safety net if you under earn. I think that's the piece that would be lost if you adopt my more conservative, meaning having fewer exogenous events as opposed to this. I could see it being almost unlimited to what the company could file and say, well, this is it's outside base rates, it's prudently incurred, it's not addressed by an existing rate, and it's material. I think that will you know, that type of a discussion is very nebulous as to what's going to qualify.
And just one example to Mr. Horton's points, like something like a cyber attack that's outside of UI's control. You know, we may have had certain controls and process in place, but if they overrode and something was material, like what just happened to American Water, does that fall into this?
I also just wanted to add back to the cost containment thing. What occurred to me after I gave my first answer is, I think the difference here too is that these costs, at least as we see them, are coming in, the companies are coming in to seek recovery of actually incurred costs that are going to be subject to prudency review, which is not the case for the ARM, right? Like the concern for cost containment mechanisms in the ARM is that we're setting it and then there is no look back to reality and reconciliation to reality. So if I can talk up the OCC and our crabs a little bit, the companies are going to know that when they come in to get these costs recovered, there are going to be people asking questions about if there were different ways that could have, like if there could have been more cost-effective ways to do these things. Everyone have an opportunity to make those arguments. And that's not true of base rates. So I think that's, although obviously we have concerns for cost containment mechanisms in any cost recovery area, I think the fact that this is the vision here as a reconciliation to actual cost does kind of change that that concern. At least it moves our perspective on it a little bit, if that makes sense.
Thank you for that. Another question to OCC. Are there any temporal boundaries related to an event that would limit consideration of inclusion within a Z factor?
Temporal, like
Time limits.
chronological. Do you mean like this, what we were talking about before, like the closeness in time to the incurrence of the cost to the review period, or do you mean like the scope of something like an event that takes 5 years or something? Is that which of those do you mean?
So what had gone through my mind partly in relation to what Ms. Van Lilling had mentioned before. I think there's two different issues I'm thinking, which is I'll use a storm as an example. Should a tree be cleared within a week, a month? Maybe there's other factors involved, the size of the storm, and also the time for, should there be a time limit on collecting the invoices and make the payments? You had said you normally get everything within 3 months. Let's say a vendor doesn't give it to you within 6 months. Is there a cutoff? We say no after 6 months or after a year, something. Are there any time limits either related to the actual incurring of an expense or payment of an expense? I guess those are the two things I'm curious about.
Yeah, I again feel like it's a case by case basis thing. I think there maybe is a moment in the realm of reasonableness where I can imagine like a utility coming in 25 years after incurring expense and seeking recovery of it. I think it would be pretty safe to say that's unreasonable. But I think it would come down to it would be a prudence question, I imagine, like what the company has been doing, if there's a reason for those kinds of outliers. In my mind, what my mind immediately goes to is the question of carrying costs. I think like that there could be a determination of whether proposed carrying costs are reasonable in the scope of that conversation. So if there's something that was within the utility's control to expedite the gap between incurrence and recovery that the utility didn't take advantage of, I could certainly see us making the argument that why should we have to pay the time value of money for time that wasn't prudently used? Hopefully that answered some of your question.
Thank you. I don't know if.
It's hard. I also think it's on a case by case basis. I think I keep putting storms aside storms is really a separate discussion in my mind, but I do think there's a timeliness of the need to request it and then seek recovery of it. I could see, because again, in the way that I am viewing it, it would have to be a specific triggering event. So the cadence that I would envision is that triggering event happens and then a reasonable period of time would pass where we would be trying to evaluate what is the cost change to comply with that triggering event. But we may not know the cost change. So that's where you could have an initial filing with PURA to say, this happened, we think it could qualify or meet the first criteria that we outlined in UPA 57, but we don't know the cost impact yet. So we might capture those costs and then find it doesn't hit the next criteria, that it's, I guess it's the last criteria, that it's material, and then it wouldn't be an exogenous event. But you would know, you would have an idea on, like I said, is this going to be a confined exercise, a single thing that we're going to get over the hump and know the cost, or is it going to be a new normal? And there's going to have to be some time with experience to know that. Is it a new normal that we're asking for, or is it a singular event? So I think each one's different, like the change in taxes and change in tax law, or to the extent that happens, you can roughly calculate what that would be on a cost of service at a point in time, versus other things, it may take a long time to evaluate what the annual impact is going to be and have known costs in hand with invoices to enable the prudency review.
I'll just throw in my agreement for the case by case approach. I think you think about the property tax change in Massachusetts. My recollection is that started all the way back with the Supreme Court case in like 2011 that took many, many years to work through the legal process and eventually become the new normal in Massachusetts. You think of a Connecticut specific example like UI's CAM GET liability. There was a change in how gross earnings taxes on UI's conservation adjustment mechanism were collected, I think, starting January 1st, 2020. And you could see a different timing expectation for that than a property tax change that takes a decade to become reality, and then even more years still to precisely quantify the impact on the utility. So I just throw in my agreement for assessing this on a case by case basis.
Thank you.
That's all the questions that we had for the Z factor discussion. And so I think based on the timing of the meeting and the discussion so far, I'd recommend that we take a quick break. So 10 minutes, please, and we can get started back again at 2:15.
All right, welcome back. I think we can move to the second topic.
Thank you. Operational growth was not raised or it was not raised in the straw proposal. However, it was raised in the written comments to the straw proposal, including by OCC. So just wondering if anyone here would like to offer some opening comments about growth in relation to PBR. Start with OCC.
Sure, since it's our fault, we're here talking about it. Our original comment suggested that if we're going to be using an indexed arm, that it might make sense to account for customer growth in as much as it relates to the overall revenue requirement. And I think the thought there was specific to our concerns that we've talked about before with respect to the I-X and other alphabet soup items that we're adding to the arm. The thought is to try to connect some more kind of reality of the utilities expenses, actual incurred expected expenses into the formula. And I guess, like, having been through this proceeding, the most appropriate place to do that might be something like the stretch factor that maybe maybe that is already, I don't know, something that's analyzed in developing the data that's necessary to evaluate the utilities kind of subjective productivity. That's what we were kind of thinking. I think that's how that ended up in our comments. And in kind of since we've been thinking, since we were issued an interrogatory on this subject, I think we are kind of thinking about the other impacts of actual customer growth data. And maybe this kind of sounds like the opposite thought, but then we started thinking about, well, customer growth, we're sure it has an impact on overall utility costs. It isn't a one-to-one impact, it seems to us, in any respect. So we need to kind of, if we're taking that into account, we need to kind of determine the degree to which growth impacts any particular cost. And then we kind of thought more about that and realized maybe even like rate class level customer growth needs to be evaluated separately. So maybe it doesn't even make sense to think about particular accounts or particular meters or even particular load, because different kinds of customers imposing those different kinds of costs also carry with them different levels of cost. So maybe I have now talked everyone out of considering customer growth, but I just wanted to kind of catch everyone up to what we've been thinking about the topic.
And I'll just say I'm looking forward to learning more about what everyone else is thinking, and even Attorney Wheel's opening remarks were insightful for me. I think we like the idea, obviously, of linking the arm to reality. We've expressed over and over again that any rate-making mechanism that comes out of this reopener must provide the utility a reasonable opportunity, but not a guarantee of recovering its costs, and that opportunity will be defeated if the plan is not linked to reality. So I think conceptually, we are completely aligned with where the OCC is coming from there. But I think also where we're aligned with where OCC is coming from is we have some questions about how that would work, and some concerns that we cited in discovery. I think for us, it was UPA 62, where we brought in the link to the throughput incentive, and how do you introduce growth into the revenue formula without reintroducing the throughput incentive was challenging for us to think through. But I remember back to, I think it was our last technical meeting in this reopener, where the last topic was, what is the link between integrated distribution system planning and this reopener? And I think one of the things we talked about was integrated distribution system planning might inform the approach to capital cost recovery that is selected in REO1. And if there's a utility that is experiencing a significant amount of growth and will need to invest a significant amount of capital to accommodate that growth, yeah, that might lean you towards one capital cost recovery mechanism versus another. So I think I do appreciate and agree with what Attorney Wheel expressed, that there is a link between growth and the revenue adjustment mechanism that comes out of this reopener, but I had questions about how that would work if you insert an extra letter into the formula here.
A couple of points that may also link this a little bit to prior discussions we've had about the ARM and how to set up the ARM in a holistic and comprehensive way. The selection, for example, of an inflation index that you're using, also the determination of what X factor you're using. So when us and other consultants do total factor productivity studies to support the determination of an X factor, growth in customer numbers or billable units is a very important metric that we use in our TFP studies to actually analyze total factor productivity growth historically. And so it is reflected, historical, at least customer growth, will already be reflected in the ARM through the X factor choice. So to the extent that you're looking, I think about then, again, from a holistic basis, you've calibrated the selection of the inflation index, the determination of the X factor value based on empirical analysis of historical productivity trends. You then need to also think about how the future may or may not differ from the past. And this is where I think, to the extent that you think about introducing another component to the ARM that reflects customer growth, you want to be thoughtful about why you're doing it in the first place. And there are reasons, we can see already policy reasons, for example, with electrification, that indicate that the future should be different from the past that we use to calibrate the values for other values to the ARM, and that would justify it. And we have examples from other jurisdictions that have done exactly that they have incorporated a separate customer growth factor in the formula to account for those differentials as they've gone through various policy changes over time. At the same time, there may be other areas to look at it. It may not need to be part of the I minus X portion of the ARM. It may be better placed in thinking about it as part of the capital funding mechanism, the K-bar. And again, we have examples from other jurisdictions that have done that. And when we look even broader than North American jurisdictions, that's exactly where customer growth impacts PBR in Australia, in the UK. It's really in thinking through the capital components of their TOTEX formulas and thinking how customer growth interacts with that to make sure that, going back to what Doug said, that you're starting off comprehensively with an accurate understanding and representation of the total cost of service for the period of the PBR, so that there is an opportunity, but not a guarantee, for the utility to recover its complete cost of service for its future operating conditions.
Thank you. A question for OCC, and I think you touched on this with your opening remarks, but in case there's anything further to add here, what does customer growth do for the framework that no other mechanism is addressing?
Yeah, I think I kind of addressed it to the extent my opening remarks made any sense. That I think growth, yeah, I think our concern generally is that we think that customer growth can be helpful to us to understand and evaluate projected forecasted costs, both capital expenditures, as Mr. Hurwitz was getting at, but also there is some degree to which some O&M grows as overall sales grow. So sort of more coming at it from a perspective of that growth should be a part of the justification, I think, for what the expected costs are. more so than from the angle that we can't forget about customer growth, because nothing else in the formula is covering it, if that makes sense.
Do you mind if I jump in?
Yeah.
I think, so I think this goes back to some requests or comments we'd made in earlier of these tech sessions. In terms of it would be helpful to have an update as to how Pura or staff or whatever is thinking of PBR, because as I look at the straw proposal, a stagnant document from last November, a lot of the things we're talking about aren't addressed in that framework. So customer growth isn't, but also post-test year adjustments aren't. There's no acknowledgement of a capital cost recovery mechanism. There's no change in revenues after the first rate year from what I can tell, other than the X factor or the I factor, with X being set to 0 or not having an X factor. So as I look at that, we have the continued concerns to say it won't do the things that Ms. Freyer did. It will not result in a framework that allows for us to have rates that recover our overall cost of service in any given year. And when you have full revenue decoupling, so you're reconciling to a now static target revenue that's only adjusting for I, you're not taking into account the actual capital cost pressures on the company. You're not taking into account whether customer growth is contributing more or less than what's provided for by that I factor. So the discussion of whether a customer growth factor is necessary or not depends on if or how that stagnant straw proposal from November of last year has changed, or what the framework is that Pura is now contemplating. Because I could see customer growth not being a necessary component if we're talking about performance-based rate making with I minus X, and X being designed based on a total factor productivity study, and having a K-bar type adjustment or some other capital cost recovery mechanism that would include capital expenditures necessary to enable additional customer growth. If you have revenues provided for some other way that acknowledges that there are costs associated with customer growth, and the PBR formula being designed holistically recovers those costs, you may not need a customer growth factor. If it doesn't, you might. So it's really hard to evaluate whether or to what extent a customer growth factor is needed or not. Say based on the straw proposal, it's needed, but there are other significant deficiencies that far outweigh concerns I would have about customer growth, because it just can't get off the ground because of those other deficiencies.
Thank you, Mr. Horton. I want to bring it back to the question at hand for OCC, and thank you, Attorney Will, for the response that you were giving here. I want to just think about some specific examples or some other places though where customer growth could be accounted for. And we've heard from Ms. Freyer about its consideration and an X factor. We've heard about and discussed the potential inclusion with respect to a capital plan or an integrated distribution system plan. And another place where, or is it also the case that another place where customer growth could show up is in the going in rates, and say any known and measurable adjustments or any that would be made to the costs in a test from a test year to the going in rates?
I think so, but I think my understanding is that that would be or should be captured in the total productivity study. I mean, I think that's because I think that's sort of getting into the question of, you know, where you're setting, oh, sorry, I'm realizing, yeah, going in rates as opposed to the multi-year rate plan. Potentially, because I think to the extent that we're setting going in rates the same way that we're, as we've discussed, kind of setting rates here, if there's expected known and measurable customer growth between the test year and rate year one, that ultimately impacts a cost going into rate year one, then that makes sense. Although I'm not sure whether, again, in my mind, looking at customer growth, I see it more as from the angle of expected customer growth being used as sort of supporting evidence to demonstrate why particular O&M line items or particular capital investments might need to be upwardly or downwardly adjusted in the first rate year, as opposed to like customer growth in isolation being set for going in rates, if that makes sense.
is it maybe a way to make sure I understand that what I think you're grappling with is there are a couple of places where customer growth could show up, and that it could be in a known and measurable adjustment, but it could also be in if a total factor productivity study is conducted and an X factor is selected, that's another place that it could show up. And we've also talked about the example of in the capital plan. So then I guess my follow-up to that would have to be, how do we account for the potential duplication of growth costs if there are various places within the framework that customer growth can be manifesting?
Yeah, and I think that kind of gets back to the point I was talking about earlier, and I think Mr. Horton was also talking about, which is that it gets hard to know. It gets hard to kind of set a knowable revenue impact, like using something like a distinct growth factor. But I think like this kind of just occurred to me, but it's sort of similar to how we talked about the distinction earlier on in this docket between the I factor and using inflation adjustments as a known and measurable adjustment. Meaning like, let's just say hypothetically, I'm sure that there are experts at either company who would know whether this is true or not, but let's just say that a customer service O&M, let's say an FTE for customer service, there's some way to know that for every 300 new customers, that means the company needs to hire a new FTE. You could use that information, I think, to adjust the customer service FTE level from the test year into going in rates. And that would be reasonable. And then there'd be kind of the second question of like, okay, let's say we're looking at a 3-year multi-year rate plan, how do we account for, if we believe that customer growth had that impact on the revenue requirement shift from the historic test year to the going in rates, how do we, if at all, capture that within the I minus X factor? And that sort of gets into the more ambiguous discussion that I think we were having at some other technical meeting of, at some point, we're departing from reality anyway, right? Like, so at some point, I maybe handles some of that, or S or X within X handles that same effect. So yeah, I guess that's all a complex way of saying, I don't know that it does make sense to have a growth factor as part of the ARM for all those reasons. Although I do agree conceptually that the revenue impact that customer growth is reasonably expected to have should be accounted for within what we're trying to do when we set multi-year rates.
Thank you.
Can I jump in a little bit on the same question, Mr.
Please, Ms.
Kramer?
Gray.
So I actually, you started off by asking whether customer growth could be accounted for in known and measurable adjustments to going in rates. And I think what we want to clarify is, yes, but that's customer growth over a very specific period of time. Let's say if over the period between when the case closes and the start of that first year, it's not accounting for customer growth from that first year into the second year, the third year, the fourth, like over time, over the PBR term. And so the reason I want to make this point, and I think this is quite important to address your second question about duplication or double counting, going in rates give us a snapshot in time. They're not a growth rate concept at all. The growth rate concept that we have in PBR is the revenue adjustment mechanism as a whole, which includes the ARM, the I minus X, and may include the K bar and other components. That's that piece is actually changing year over year, which is what a growth trend should indicate. So I think that there is actually no duplication between making known and measurable adjustments that may impute additional costs from customer growth into the going in rates, because those all happened in the past and you can document them. But then you still may need to, if you believe that the X factor isn't capturing the expected growth going forward for the term of the PPR, make additional adjustments or accommodations within the broader revenue adjustment mechanism. And again, a great example, just numerically, let's say that historically for the period of the productivity study, the TFP study that you do to set your X factor, the electric distribution sector in the United States was growing at 0.5% per annum. But because of known policies today, we can anticipate that there is pressure on the utilities from electrification things for customer growth and billable unit growth to go to 2% per annum on average. Well, I think there's a big delta there because the X factor that you said based on the historical productivity study will only capture the 0.5%. And we're still missing the 1.5%. Now, I agree with Mr. Wea that there might be different relationships then about how that additional growth from electrification could drive costs. And maybe the better place to capture it is in the K-bar or perhaps in a customer growth number. Even that customer growth number could be designed mechanically to ensure there's no double counting because it could look at customer growth above and beyond the explicit level that you found through the empirical study of total factor productivity. So there's ways, I think, mechanically to make sure that you should have no concern about double counting. I don't think it's actually that hard of a exercise, empirical exercise.
And if I could just add, and I think just going back, I was trying to react to the initial question of how should customer growth be factored into the framework? And I'm just pointing out, if we're talking about the framework in the straw proposal, I think there's a couple things to consider. On the cost side, the question is, does customer growth contribute to a level of costs that aren't reflected in the cost of service? So you could incorporate those as a known and measurable adjustment. The straw proposal doesn't describe how or when customer growth would go into that, and it limits the amount of known and measurable changes. So for going in rates, I don't see how the straw proposal would take into account cost impacts and increases due to customer growth. I see how on the revenue side, if there were customer growth based on the straw proposal, the full revenue decoupling mechanism that is unchanged by the straw proposal would give back credit for any of the incremental revenues that are recovered from customer growth. So that's for the going in rates. For the pendency of the PBR term, the straw proposal declares there's no X factor and there's no capital funding mechanism and retains the full revenue decoupling mechanism so that over the course of the PBR term, any revenues that are generated by customer growth would flow back to all other customers, meaning would not be available to the utility to fund the incremental costs to support the customer growth that has materialized. So on the cost side, I guess my point succinctly is under the framework that is before us, there's no mechanism right now that accounts for customer growth. That's one of many deficiencies in the current straw proposal. That's all I was trying to point out. If we're talking about conceptual ideas that we've mentioned, for K-bar or incorporating an X factor, which are ideas that have been discussed around this table, I think it's a very good discussion. Is customer growth needed? And I could argue it's not if the K-bar takes into account the capital necessary to support that customer growth. And if the I minus X formula takes into account the incremental O&M that would be necessary to support those incremental customers, even giving back the revenues from those additional customers through the RDM, I don't know on its face would be unfair or objectionable from the utilities perspective. We have additional revenues that are being reflected in the revenue decoupling formula, but our revenue target is adjusting over time to account for the incremental capital through a K-bar, which is not in the straw proposal, and an X factor that's designed the way that Ms. Freyer just said, which is not in the straw proposal. So to answer the question, I think we have to understand what is the framework that we're talking about. In the current framework that's before us doesn't take into account customer growth. It doesn't acknowledge that it could impact our cost of service and warrant a revenue adjustment. And there, like I said, are other more significant deficiencies in the straw proposal that couldn't be solved by adding in a customer growth factor. That was my only point.
Thank you for the clarification on your comments. Any other questions on customer growth? Yeah.
Question for OCC. Referring to UPA 62, OCC states, if a growth factor is explicitly incorporated in the ARM formula, the determination of the factors should consider several elements. And then the response goes on to list the elements, including types of costs. Does OCC have a view as to the types of costs that should be incorporated?
I mean, I'm just, I'm struggling to think of anything beyond what I've already said, which is, I think what we are trying to communicate there is that the costs should be those that are influenced by customer growth. I think we were kind of trying to make the point that that not all costs necessarily are, and that the costs, the categories of costs that are influenced in different ways. I mean, like, not to repeat what I said before, but that backing up a little bit, because I guess it depends on whether, if you're talking about growth, how do you measure growth? Is it just sales? Is it new accounts? Is it meters? Because I think however you measure those things, there are kind of exceptions that you would need to account for that kind of would throw some wrenches into your data. But anyway, the point we were trying to get at is that that needs to be considered. So if the authority were to implement something like a growth factor, we just need to pay a lot of attention to, like, what exactly do we think is influenced? What part of the revenue requirement is influenced by customer growth, and in what ways?
Thank you. So, anyone else?
Again, maybe, again, hypothetically or conceptually, when you do a total factor productivity study and you're using actual reported data from the utilities, those relationships about which costs, various costs, that would be both capital and non-capital O&A costs, how they interact with either energy sales or number of customers served, those will be captured in that empirical study. So that's just wanted to lay that comment out, because I think there is, at least historically, if a TFP study is done, it will provide a lot of information that could address this question that you're asking on those relationships.
Thank you. Ms. Lupoli, if you could advance the slide. So moving on to the management audit, and it is an audit of all or any portion of the operating procedures and any other internal workings of any public service company. Just wondering if anyone has any opening comments on management audit.
I do have a couple just comments and observations, I think, and I want to preface by saying we're not opposed to management audits. I think, there is a time and a place, and they can add value to us and to other stakeholders. And certainly it is a law here in Connecticut that they occur no less frequently than every 6 years. I think there are practical considerations, and also understanding the goal and objectives of a management audit as it relates to PBR that I would just ask to be considered. For instance, it is a large undertaking. For Eversource, ours started in 2022. We engaged in 800 data requests. It was for our 3 Connecticut operating companies. So, at least for Aquarion, it was probably double and potentially triple, because Yankee and CLMP might have slightly different responses. But suffice it to say, it was a large undertaking to support, and something, again, we're totally willing and able to do. 70 management interviews. The result that we were engaged with, or the process, I should say, that we were engaged with, took the better part of a year, if not longer. I think our first kickoff meeting was in October of 2022. We've still not received the result of that management audit. I understand Pura had a draft at some point earlier in this year. We just got word from the auditor that we should have it soon. As everyone knows, due to Pura's request of Yankee to file a rate case by December 2nd, we're on the precipice of filing a rate case without the benefit of the audit in hand. But I also don't know if an audit will time and again produce information that's relevant to a PBR. There's reference to the Hawaii example, which certainly that management audit did identify specific and targeted areas for cost efficiencies. But I don't know that you're going to see that. And if Hawaii were to have another management audit, say 2 or 3 years later, which based on this schedule would be contemplated, I can't speak to what would happen, but I would be surprised if the auditors are continuously finding and recommending wholesale changes to the structure of a company. I don't believe that's the intent of a management audit. Certainly, if there are things that come to light that point to that, then that would be relevant to a rate proceeding for sure. But if you look at the Avangrid or UI and Connecticut subsidiary management audit, I didn't read it cover to cover, but I didn't see any such examples. And certainly Andrea and Jacob can correct me. It was more around recommendations for best practices and either adding or eliminating certain redundancies or processes that may or may not be relevant. All helpful information, but doesn't get to, in my mind, like a cost efficiency study or directly relevant for either setting base rates or determining whether or not there are efficiencies to be gained during a course of a PBR term. There are different studies that do that, different engagements that would do that, and potentially may not always be relevant or may not always result in something like that. So I just think it's important. I hope that we consider, is it really producing value? Because there is a cost and a time commitment that's necessary to support such an engagement. And it's not insignificant.
Thank you.
So I echo what Mr. Horton just said. Our audit took a bit less than what it seems like Mr. Horton's did. It was started in March of 2022 and it was completed by June of 2023. But since I've been at Avangrid, we've had the Connecticut audit that's in the record, as well as I've been through one completed New York audit, and we're currently undergoing another New York audit, as well as a Maine audit. And to Mr. Horton's point, depending on who the auditor is, depending on the number of data requests, they can take a different amount of time. So this was a shorter one. I've experienced much longer ones to the point where how does it fit in? How are we going to fit this into PBR and fit this into the timeline of when everything needs to be done would be something that we need to take into consideration. You'll also see, if you look at, different states and how they've done management audits, you'll see, depending on who the auditor is, they have different points of views and different recommendations. And we completely agree with management audits. I think they are healthy practice. I think they're always value added, but you're going to see that some might have one view somewhere and some might have a different view somewhere else. So, and I was an active participant in this audit. I have read it to cover. The recommendations don't produce like dollar value results. So there's no efficiencies in here that say you should do this and you're going to get this amount of money. And a lot of times, and there are recommendations in here where one of them is your time off, your PTO is not in line with your peers and you should offer more PTO. That's reverse of what you're looking to do with efficiency. So they say in order to attract more talent, you should be giving people more time off in the first half of their career. Well, if I give them more time off, I need more employees and I'm not getting as much work done. There's a lot of, the majority I would say are operational or different reports based, making sure you have certain clarity of information, that you're communicating information, that people are looking things a certain way. And that's a lot of the recommendations that are in here. And once a management audit is done, we'll have a plan. We'll take all of the different recommendations, we'll put them into place. But you'll see that even between the different states, the different auditors will come up with different items. And I just struggle with, and I looked for the Hawaii report with the $13 million because I would love to see how they came up with that. I looked for it online. I couldn't find it anywhere, but I would love to see how they actually quantified what their findings were for dollars that you would say.
If I can maybe address some of the questions on Hawaii.
Ms. Fair,
Oh,
can
yeah.
we conclude our opening remarks and then we'll get to the discussion.
Sure.
Thank you. OCC.
Sure. So, we're obviously interested in the management audits, as noted in our comments. I'll agree that the management audit can obviously take a long time. The one thing I would say that maybe there are some areas that we could target, areas that during rate cases come up quite often. And maybe that's something that we should spend some time going over or thinking of in the future. For example, some areas that we that always come up that need some clarity, and to some extent are help, at least myself, I was helped by reading through the last UI management audit, are, you know, comp and benefits, corporate affiliates, shared services, as well as the differences in the Massachusetts formula. For example, how it's used in Massachusetts versus in Connecticut. I mean, that was helpful to myself. So maybe just having a management audit that's smaller in scale, but more targeted for areas that are often areas of confusion, if that makes sense.
I would also just add, it makes sense, the connection that I think we see between PBR and management audits maybe isn't so substantively related to like PBR, the substance of PBR, but just maybe the procedure that we've been, because part of what we're talking about, particularly in this docket, is kind of creating a new regulatory cadence for how rate cases happen. And there is a statute that requires an audit, I think, at least every 6 years. And right now, although like we get audits there, and we can certainly look at them and ask about them in rate cases, there isn't really like a connection between, like there isn't sort of we sort of have this statute saying audits should happen, and then there are these other statutes saying that rate cases should happen. So it does make sense to us just conceptually and for administrative efficiency to kind of talk about, is there a way to align that statutory requirement that's happening already for the filing and general kind of, again, cadence of how rate reviews are happening.
Just to offer, New York does have a rule that every finding in their audit needs to be addressed in the next rate case.
And I would just say, I could see some value in something like that, Attorney Wheel. I think, and there's also a lot of overlap. So I think there will be some benefit to having recently gone through it from a management audit for the company. Although we don't have the results in hand, I imagine we're going to get many similar questions. And so having it happen, you know, in recent time to a rate case is going to be relevant. On the Hawaii, I only read the executive summary of that one, but they basically found that the Hawaii utilities were bloated in certain areas and had just lost sight of cost containment, cost controls, let each area, I'm exaggerating, but it basically said this, let each area hire at their will to meet vague and undefined renewable portfolio standards requirements. That was like a blank check to go and hire. So, and they had specific areas where they said, this group in particular really needs a different management structure and accountability. And so go ahead and do that. And there was a number of different findings like that where they did quantify and said, we expect this will be on the low end savings of, I think, $21 million a year, and on the high end, $29 million a year. And I think Ms. Freyer can speak to how that was implemented. But again, that's, in my view, perhaps that will happen. I haven't seen ours. I would be very surprised if that were the conclusion, but that's also, like you said, it's not the genesis of the result that happened for it's. So it's probably going to yield useful information in a rate case, but it doesn't do what Hawaii did. That's, I guess, my only point.
And I think, Doug, you explained it really well. I think it was a number of different findings that were used in settlement discussions between parties to think about how they could affect or influence, I think is the right word that was actually used at one point in the decision, different parameters of PBR. I did want to make kind of the point that the more important point, my firm does management audits. We do quite a lot across different jurisdictions. And one of the things that we find that is when we come into a project, we're actually given a set of questions that are intended to be addressed. So to the extent that there is more alignment in the future between rate cases and management audits, it's really important for the consultant performing the management audit to know what those important questions are, because a management audit, although looking at operational and management decision-making, could also have quantitative elements to it that could be more useful in a more empirically derived rate-making regime like an I-X regime. I think that the management audit done in Hawaii didn't fully anticipate the PBR model that Hawaii would chose. So it was done, it happened to have been done before, but it not necessarily had asked very, very specific questions. So that's why it was used more for an influence type of decision-making, more qualitative decision-making. And there had to be a settlement set of discussions between the electric utility and the stakeholders and the regulatory staff to figure out how to fit it in. The other last point on Hawaii, which is also quite important, is that yes, there was essentially a cost savings or reduction done on I call it a consumer dividend as a result of the influences of the management audit, but we need to put it in the grand scheme of the entire PBR regime. So one difference that's very important in Hawaii is that although there was a reduction made or a decision made about going in rates influenced by the management audit, Hawaii also has a symmetric ESM, which means that over the term of the PBR plan, if for some reason the combination of those starting going in rates or base rates plus their I-X regime doesn't allow them the opportunity to recover their costs and the deadbands are triggered on the bottom end, then there will be a rate increase to come up with that. So in some ways, I know from being participant and listening on the sidelines of those discussions in Hawaii, that that feature of the symmetric ESM also influenced settlement discussions. And I understand, at least from the straw proposal, a symmetric ESM is off the table, or at least was. So that needs to be kind of going back to the whole idea. It's a comprehensive model. So all pieces of PBR have to be considered together.
Thank you. Question to UI. How would the company modify the scope of future management audits to optimize PBR?
So I think there is a lot of benefit in the management audits to reduce the amount of time that it takes that Pura has to review, that you could rely on certain items. You could rely on them for certain different components. And so I think to Mr. Slabowski's point earlier, if they were concentrated on specific factors, in order to, like, within the audit itself that was relied upon, that I think that would be helpful. So what we spent, to Mr. Slabowski's point, a ton of time, months with one of the gentleman auditors on the corporate costs, right? And how they're allocated to the UIL subsidiaries, specifically going through each cost causation factor, going through like how we did the mathematical calculations, making sure they flowed correctly, making sure that they hit each of the operating companies accurately. They had no findings that the dollar amounts were incorrect. They had, they said that, you know, all the dollars flowed exactly as you had said that they should supposed to be flowing in compliance with the cost with the cost allocation manual. But they came back and said, specific to the UIL entities, certain customer service functions, we use the Massachusetts formula, and they recommended using a different cost causation factor. So like the number of customers at each utility versus the Massachusetts formula. Fine. That's a valid point. And that's the recommendation they had met. And then throughout the hearings, you know, we spent a ton of time doing the same thing, answering questions on how the costs come down, the cost causation factors. So I do think that depending on what items that we're looking at and what items are coming up, like in PBR or for certain, if we have a certain factor, that's looked at and then it's relied upon in order to get benefit from these audits that are done. And so part of like human resources and the number of employees that we have to justify, okay, if we're asking for 5 employees or 6 new employees, them coming in and looking at what are they currently doing, is that need there? And there is a recommendation within this audit, particular to one customer service employee, for us to hire another customer service employee because they did determine that that headcount was needed.
Thank you. OCC?
I don't think we have, that all makes sense to us. I don't think we have anything substantive to add.
Okay. Eversource.
I mean, I guess I would just, it might be a little repetitive. I agree with what Ms. Van Luling said, that there is a place and there's value for the management audit. And I think there is a lot of overlap to the types of things that Pura and stakeholders are interested in evaluating in a rate case and establishing going in rates. So I see there being efficiencies that could be gained from having those things aligned to some extent. I also see some practical realities where that wouldn't be possible, especially if we can't have a rate case. We can't stay out of a rate case for 4 years and we need to file more frequently. It might be a waste to try to do another management audit that you've just done 2 years prior. Putting that aside, I think there's value to some extent in some of this, but your question was how would a management audit be adjusted to optimize PBR, I think, or something to that effect. And I don't see those two things as necessarily being related. I would say in my words, probably not in the Hawaii management audit, but I think the idea there was basically to say, here is a utility that has become bloated. And part of that could be because they were on a cost of service model and not having performance-based rate making, and almost to say if Hawaii were to move to performance-based rate making, or when they do, that would take away that incentive or lack of incentive to operate efficiently. So I think I would agree with that, but I don't think you need a management audit over the course of the PBR term. Again, that is one of the prior comments we talked about. There needs to be a level of trust in understanding and expectation that once we're in the PBR plan, the utility is then empowered and expected to be making decisions to operate as efficiently as possible. And I don't think we would want to be setting up a PBR framework that required an independent management auditor to come in who may have different agendas or different priorities or different focuses, or just be out to get the utilities or whatever that is causing recommendations to reduce costs that the utility itself may not be able to implement or can implement or wouldn't want to for other reasons. I don't think that we shouldn't be trying to set up a PBR framework that relies on a management audit to find the efficiencies. In my mind, it's the structure of the PBR framework itself that would ensure the utility has the incentive to find those efficiencies and also the financial resources to go and pursue those efficiencies by investing in people, processes, and technologies. The management audit is more of a check. Is there something out of whack that needs to be adjusted? Or maybe there are recommendations that management can take into account. I certainly hope there are and operate more efficiently over time, but it would be, again, I think it's different and separate from a PBR discussion is how I would see it.
Mr. Horton, I hear your point on the cost efficiencies being sought through the term of the PBR period. I want to go back to one thing I think I heard you say in your opening comments, so that the management audit as it is now isn't necessarily the right tool for identifying cost efficiencies, but there are other studies, other tools that are the right one. Did you have specific ones in mind, or?
Well, I think the total factor productivity study, cost benchmarking studies, and I think Ms. Freyer can speak to those. I think there are, like a management consulting firm may come in and recommend a reorganization. Again, it may not be the best thing for the company, but that's a different type of evaluation or analysis to say, let's restructure, eliminate headcount, whatever the recommendation may be. The Hawaii audit, and I haven't had a lot of personal experience or read audits cover to cover to any great degree, so I'm speaking with limited personal experience. The Hawaii management audit had very specific findings that said what I said. This company has too many employees for this area than is necessary and should basically revamp how it's run. And in fact, it had 2 CEOs in a period of 6 years for that very, very reason. And so I think that was a unique case. I don't think a management audit, and again, I'm going to yield to Ms. Freyer. I don't think that's generally what you find in a management audit. You find recommendations for unquantifiable improvements that, again, may or may not be appropriate for that utility to implement, but the utility would be expected to defend why they didn't. It just is, you think you're always going to find, like you did in the Hawaii example, a dollar amount that should go into the going in cast off rates, or that you can reasonably expect to point to say, here's why over the course of the PBR term, we should have some other reduction to what would otherwise be provided for through rates over the PBR term. I think that's kind of a unicorn. That's my only point.
Thank you.
I was also going to add that from our, again, experience performing management audits and maybe also advising on the general class of PBR models out there, I know that, again, in the straw proposal, there was a very specific model that was being pursued, the externally derived index-based approach. But if alternative other models are considered, this is where we have seen management audits potentially be more useful because they could speak to, for example, operational practices, whether they're best in class when thinking about how to structure capital investment plans, whether they're considering internally consistent load forecasts that consider future uncertainties, do scenario analysis. That's typically what we would be looking at in the management audit, not the specific levels of historical productivity achieved, but the practices to ensure that the practices are best in class. And sometimes that tends to be more important for a particular type of PBR model than another. So for example, if a PBR model is relying on, or a multi-year rate plan is relying on the company to produce multi-year forecasts of future cost of service revenue requirements, and those depend on having considered comprehensively capital investment plans over 3 to 5 years, those rely on having very good, to begin with, load forecasts. And so a management audit might look at the techniques the company is using and things like that. I don't think that's relevant for the straw proposal again, but it's an example to your question of how you could maybe sync up some features of a management audit with a form of a PBR regime.
I think I agree with a lot of what the companies have said here, but shifting it from our perspective, I agree that we wouldn't want to see a management audit be a stand-in by itself for a determination of what's appropriate, because it can go the other way too. Like we might want to look at a management audit that says that the company is doing better than we feel like there's contesting evidence to suggest, and be able to present an opposing viewpoint to the audit, just like the company should have the opportunity to do. So I don't know. In my mind, I think a management audit can certainly be relevant to PBR in as much as it's relevant, I think, particularly to setting going in rates, in that there could be something in there that ultimately impacts going in rates, like what I think happened in Hawaii. Like I don't think we should dispose of the possibility that there could be a similar audit here in Connecticut. Certainly not either of these fine companies as they're currently run, but it's possible, right? Like it happened in Hawaii, it can happen anywhere. And that's kind of the point of it, as I see it, is to like make sure that we're getting as much information as possible. And it's highly also likely that most of what's in a particular audit might not have any impact whatsoever. But I think from our perspective, we see it as potentially valuable, just like any other information is valuable in evaluating sort of what's happening at the company and whether the requested, revenue model makes sense, or whether there's some reason to ask further questions about it or take a different view.
The only other thing I'd offer is they're not cheap. So our audit was $1.2 million. I'm not sure how much yours is. The Connecticut audit was actually the cheapest of the ones that we've had in New York and Maine. They were more. So it's just a cost balance. Like, what are you actually getting out of it? Auditors are not cheap. Their rates are $300-400 an hour, right? So what are they really providing? And are you seeing that benefit that's coming out of it? Obviously, Hawaii clearly did benefit by these findings. But if we have to do this, we do once every 2 years, once every 3 years, you're now raising the costs that cost us, and customers in the long run.
And that was the same range, at least to date. And it doesn't take into account the company personnel that's committed, which isn't a direct, but it's certainly a cost that the more we're doing, the more it has to be reflected in our overall cost of service. And I completely agree with Attorney Wheel. My only point in saying it is the more frequently they happen, I think the less likely you're going to find the result like what was in Hawaii. If they had that was in 2020. If they had another audit today, would they come up with another 26 million of savings? Of course they may, probably not though. I just think that was a unique example that's not going to happen if you're doing it every 3 years.
Okay. I think that's all the questions that we had on the management audit. And that brings us to the close of our our planned agenda for the day. So Chairman, that's all the discussion that we had planned. Would you like me to close out the? Okay. So with that, we're done with the topics for today. We, of course, will continue issuing discovery through the docket, so please stay tuned to that. And our next technical meeting is scheduled for November the 18th. So we'll see folks back for that and see many of you next week on Halloween for REO2. Thank you.